Good morning. This is Ken Long at Tortoise Capital with the review of the weekend trading report for September 29th, 2018. Happy birthday, Rachel. So the market is in bullish, quiet conditions. That's favorable for the long side. The annual basis, looking at the NDX 20, we are overbought at 93 out of 100. The 10-day NDX has pulled back to low neutral at 34 out of 100. In the market mosaic, price relative to the 200 is white bullish. The slope of the 50 has decayed to 0.37, so red neutral. Strength of trend in the S&P is 12.9, so weak, very weak. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the boundary between risk on and risk off. Current reading is at 1.044, so we are well into risk on. You take that score and look back at the last 5,000 trading days to compute the risk Z by finding the average and the standard deviation and then computing the Z-score. That comes in at 0.39. That means we are 0.39 standard deviations above the long-term average in terms of the risk Z, which means this is favorable for swings, and the fact that we have a resumption of the move up is a powerful indicator. This was the last time it did this. This was a good swing. This was a good swing. And anytime we're above the zero line, we have a long side bias. The fact that those recent volatility moves have not even gotten out to -1 SD has also been a favorable for the long upward grind of the past, 3 to 4 weeks. Blended monthly rebalancing will be happening start of next week. These are the leaders in the clubhouse now. Those would be the ones that we implement. These are the holdings for the month of September, and all perform pretty well. These are the leading candidates in the different stock indexes and ETF indexes as well for reference. Pfizer and Merck have been really, and Nike have been very powerful. In ETF2, for the first time in probably 3 months, we've moved up in the theoretical exposure from 40% to 70%. The rest of the world's indexes have now caught up to the U.S. in terms of the recovery. Quick look at some of the ETF portfolios through the blended monthly rebalancing lens. Buy and cash signals are price relative to the 4-month moving average, and we sort based on the 3 and 6 month blend. You can see that technology and Latin America both had pretty good weeks. Latin America may be leading that recovery of the rest of the world right now, so we'll keep an eye on that one in Brazil in terms of swing trading. In the ETF 32 portfolio, you see there's Brazil starting to recover just like Latin America. But the leaders in the clubhouse on the blend are still all of the U.S. all the time. Healthcare, that's where that Pfizer and Merck have really been participating in the sector rebound, followed closely by technology. Gold, agriculture, bonds, emerging markets have been just lagging everything. Dow 30, Apple, Pfizer, Merck, Nike, you can see the gains these guys have made. And comparing that to the horror show that is GE and Intel. Sector spiders, the usual suspects leading the way, lagging in the maybe the more defensive plays or financial areas. ETF Max looks at about 500 liquid ETFs and applies this lens. See the big winners this week been biotech, healthcare, aerospace, more healthcare and oil. Market health check looking back 10, 20, 30, 40, and 50 days. These horizontal red lines are support levels that used to be resistance levels. You see the 10-period RAF regression channel is basically flat. The 30 still grinding upward. This has been a really grinding upward move here in the S&P as it has achieved new all-time high here and is still holding support. Slope of the 270 is up. The slope of the river is up. The dragon has been riding the outer edge of the river for the long time. You see the volatility beginning to compress once more as the Z3 lines collapse. In the 4 seasons of MACD, we've gone through from basically bouncing back and forth from summer to fall, summer to fall, summer to fall. What makes this summer is it's above the 0 line and the slope of the signal line is up. When that crosses over the 5-period moving average and is sloping downward, then it becomes a fall. Now, these are areas here when we get in the fall, meaning it's above the 0 line, but then crosses back above the signal line. I take that as a high payoff vote to the upside, like a pocket re-entry, because it didn't fail all the way back to the 0 line. It has resumed, and you can see right around in here, this failure to fail back to the 270 was a signal upward. And then you get another period of summer, and then when the slope of that blue line goes negative, it becomes the fall because it's sloping downward and above the 0 line. And then here's the next buy on dip opportunity was in here. So I'm still holding out some hope for a recovery, although we had a very brief summer. This didn't last as long as this second summer, so that could be running out of steam or political shenanigans taking effect or people locking in what they have and waiting to see what the upcoming November elections are going to portend. I think that's going to become increasingly more important, and I'm not expecting runaway breakouts to the upside. This is a time, I think, to be playing tactical defense for the next 6 weeks, and that's going to shape my thinking for swings and opportunities. Next up, let's see. Okay, ETF regional report. This again, we've gone from 40-60 to 70-30 because 7 of the indexes are on buy signals. You can see the usual suspects leading the way here in the S&P sector spiders. In the world market model, all the large caps and most of the tech leading the way in the U.S. You can see that reflected in the business sectors here. China, the rest of Asia, mixed bag, and then mixed bag in Europe, so it's really still the U.S. all the way. ETF top 30, based on the ETF2 lens, you can see the key leaders in this area here, all basically U.S. tech and healthcare, some emerging strength in the diamonds. So green and white is an area I like to look to exploit the longer term relative strength. So that's going to be in the S&P and the diamonds. That's really good long term for the U.S. large caps. You figure they would be best positioned to handle any kind of political turmoil because they've had the relative strength. The rest of the world is still weak. And if the Democrats seize control of Congress, then that's going to lead to more gridlock, and that's always favorable for business. So I think we're starting to see positioning to reflect that real possibility. ETF liquidity, just for reference, these are the top 30 based on average daily dollar volume of the last 30 days, and then how relatively volatile they are. Those in the green are both liquid and volatile enough for short-term trading. Shifting to the daily for Monday, no signals in channeling and overreaction. You can see the usual suspects here in the max pains. GE has just been getting crushed and makes it an interesting target. Dow Tactical, lots of auto framers to choose from. We've had some pullback these last 3 or 4 days, so there's some good reward to risk ratios being set up. Again, some of these like GE and DuPont, when they fail on the long side, that's a signal to go short and to take advantage of their relative weakness. Apple has had some relative strength, as you can see, as has Boeing. So those are definitely playable. Even though they have no other signals, just the fact that they've been standing out so well on the relative strength is a vote in their favor. ETFs, again, also lots of good auto framers to choose from. 4 choices that test out well in the RSI2. Lots of good fraud quality numbers in the declining volatility that we've had, a few channelings and some 551Ws to take advantage of as well. Breakouts here in oil on all time frames and in healthcare. So XLV still looking interesting. Pinch and stretch report. 4 categories. Prices stretched above the river, and this is the percentage above their Bollinger Band mean, and this is the measurement in terms of the standard deviation spread. So you can look at both of those. So Disney, oil, and Japan are both in that category. These are the ones stretched the most below their Bollinger Band mean on the basis of the standard deviation. So again, you can see that's DuPont, Goldman Financials, GE have all been getting smacked. The most expanded pinch boxes, these are the ones that have very wide rivers. And it takes like a 30-day exceptionally directional move to create a wide river because of the volatility of price. And so it doesn't tell you whether these are above or below the line, but when you look at the chart, you'll be able to see that pretty clearly. And then the most compressed pinch boxes, or the very narrowest of rivers, this is all very, very attractive to me because we're going to show some evidence in the Advanced Swing Course Home Study update tomorrow that initiating swing trades from pinched conditions is one of the best setups that you can have. So all of these are interesting candidates for pinches, and I like to see that U.S. Tech is at more than one standard deviation below average in terms of pinchiness, meaning that it's very pinched, and the small caps are very pinched, and the S&P is very pinched. So that's all bodes well for swing trades for the next couple of weeks. Just quick summary there of the auto framer and a bunch of mechanical setups on the basis of trade location with price respect to the 10-day. Regression line fractals is another nice way to find those relative strength leaders and laggards. This is measuring the numbers of ATRs above or below its long-term fair value that they are. So you can see Intel is 6.5 ATR below its long-term fair value. So let's take a look at what that looks like. Actually, in the interest of time, I'm going to cover that during the podcast tonight in order to get this thing done. So I'll go through some of these candidates in the podcast for subscribers, because again, I think we got some nice swing trade opportunities coming up. These are the daily squeezes. These are one-day range compressions compared to their ATRs, in which if we get a breakout above yesterday's high or low, you have an opportunity for a nice one-day, like an uncoiling spring kind of a trade. So interesting to see Verizon, United Tech, Microsoft, IBM, and Walmart in that stack. The 4 seasons of MACD, these are the symbols ranked by their season and then sorted within the season on the basis of their MACD Z-score, and that is where is that price compared to its own MACD river. And so in the spring, Walmart will have just turned, so it's below its zero line, but the slope is up and it's still well below its zero. That's a swing trade waiting to happen. That will find you something very much like an owl. Intel is already above its own river, although it's in the spring, and so that is later on in the season. Intel is where Walmart could very well be. So Walmart would be a high pry candidate for like an owl for me. Fall, where you have a negative z-score, means that it is that signal line is declining, but it's already also below its own river, so it's fallen quite a bit. These where they're still well above the Bollinger Band, or the Bollinger Band river for MACD, means that they have already experienced a really powerful move but are starting to decay, and they're still well above. So these are ones who want to profit. We want to lock in those profits. Those in the winter tell you just they are just in extraordinary pain. So DuPont, Verizon, Apple have all been suffering. Those become candidates for either short on a weakness or stalking the reversal back to the zero line with owls. So once they get out of this kind of a category and it starts improving, the MACD line hooks up, you're right back into the top of the stack up here in Walmart looking for owls. The ADXstat, this is just a draft report where we're showing the statistics on strength of trends. So Pfizer has a ADX score today, ADX 14 score today of 58. That has a Z-score value of 2.6 based on his average ADX over the last 500 days has been 25, and the standard deviation has been 13. So when you do the math, that is a 2.5 sigma stronger trend than the 500-day average. So these color combinations here show you the boundaries. Now the strongest it's ever been was 61.2 in the last 500 days, which was a Z-score of 2.8. So the directional trend in Pfizer has been pretty darn extraordinary. Now that leads you to one of two conclusions. If you're in it, you definitely want to be locking in those gains and paying attention to your profit preservation, and the same with Merck. At the same time, any weakness in there could be potentials for reversion to the mean because it's come so far. So these now become really strong candidates for that kind of reaction trend. So you're either going to get a strong continuation because people have been believing in this for so long, lots of emotion, or when it cracks and they start locking in their gains, then you get a sharp counter reaction trade. So these green lines in the Z-score tell you that it has just moved into exceptional territory. Now, conversely, those in the red, these are symbols that are extraordinarily untrending. So it's almost like the sideways, extreme sideways, and we don't know if it's a channel or not until we look at the Bollinger Bands. But this would be candidates to start looking for exactly that kind of Z3 pinch. Market has just been grinding north. Got another little leg getting ready to go up. The slope of the 30 is really at the long-term average, so this is a normal-looking stretch, finally, of grinding upwards movement. You can see how that has been relative to the 200, just slowly improving and gaining. So this is slowly gaining steam on that long haul. And for historical reference, so you can see where we are over the last 10 years. The slow decay of volatility is measured by standard deviation divided by price. And then the volatility has just been really crushed out of this, and we're bouncing between quiet and normal. The slope of the Z-scores for the 10, 30, and 90 RLs. The 10 is right at the zero line. The 30 has been decaying, so there's room for it to grow. And the 90 is kind of flattened out into just a stable long-term upward grind. That's how you read that. So this is continuing to ride the rails, and then you can see declining volatility as they start benching. That's what that's like. Last time it kind of did that was around in here, and probably right in here. Slight pullback, and then that resumed. So still cautiously optimistic to the upside. And that's everything I wanted to cover. We'll just flash through these for your own reference. And thanks for your kind attention. See you in the chat room and on the podcast this weekend. We got some amazing research results to present for this weekend podcast, so I encourage you to make it if you can. Take good care. This is Ken at Tortoise Capital. Keep your risk measured and your powder dry.